Today, we are diving into the biggest company in the semiconductor equipment and materials industry, at the giant ASML. We'll look at its financials and use 3 different valuation methods to find the price range based on the growth ahead. I'll also reveal my personal buying price. From this table over here, we can see that there is quite a gap to the applied materials in terms of a market cap, even though the revenue is only slightly higher for ASML. Jumping over to our financials, where we have data from 2009 to 2024. We'll disregard the 2009 numbers due to negative net income, EBITDA and free cash flow. Reasoning being, we won't be able to calculate yearly growth. That is why the CAGR is set from 2010 to 2024. And for revenue, we have a yearly growth of 12.4%. And looking at our numbers over here, we can see only in 2012 and 2015, ASML had a negative growth, and otherwise, the growth is very impressive. Gross margins and gross profit margins are also expanding. As we can see, in the last 4 years, they surpassed 50%, while in the past they were hovering at around 40% and moving higher almost every year. The same is true for net income and net income profit margins, where we can see that they are now hovering at around 28 to 30%, while in the past they were lower. And the same also applies for EBITDA, that is now hovering at around 35% and in the past was at around 30% and even lower in some years. Cash flow from operations is a little bit more volatile, with some very high years like in 2021 and some very low years, but it is also moving in the right direction. And if we sum all the cash flows and EBITDA numbers, then we have a very good relationship. And as we can see actually from our graph over here, that cash flow from operations and EBITDA are moving in the same direction. So we have a blue line for EBITDA and cash flow from operations in the red line and red dots. And in the past few years, we can also see that cash flow from operations surpassed EBITDA, which is also nice to see. Moving on to CapEx, is the same as we saw for applied materials. It is increasing in the last few years and it's taking much bigger chunk of revenue than before. From here we can calculate free cash flow by subtracting capex from cash flow from operations. And here we can also see that free cash flow, it is growing in the positive direction for us. Moving on to shares outstanding, here all things are not so rosy. In 2012 they had a high jump in shares outstanding, but in the last few years they are decreasing for the most part, but they are still not at 2009 levels. ASML also pays dividend, which grows at 22% annually, and this is only looking at cash amount. Now if we take shares outstanding into account, then the percentage is a little bit higher and closer to 23%. With dividend per share being currently at $6.74, with dividend payout being at healthy 32%. Now we can also calculate free cash flow from primary business. To do that, we'll take net income, depreciation and amortization and deferred income taxes, sum all of this together, and from the number subtract capex and common and preferred dividends to get our free cash flow from primary business, which is positive in all 6 years we calculated it. So this is very, very good. And our average comes at 3.1 billion. And from this over here, we can already calculate our first stock price by multiplying the given free cash flow with 20 and divide it with the shares outstanding. Then we can also add in cash and subtract debt. And as they have more cash than debt, as we will see later, this gives us a stock price of $177. And this is PE of 8.5, but this is very low. If we look at the average PE, it's actually closer to 32, with lowest being at around 6.5 in 2011. Looking at this stock price from that perspective, it is way too low. To get our next 2 valuation models, we'll need to look into the future, and we'll do that by using 3 different valuation projections. So our first 0% growth is our baseline to see how much the company is worth today. Then our next one is set at 10%, which is slightly below historical average, while 14% is slightly above historical average, as we see from 2010 to 2024. For net income, we'll use, based on our historical numbers, net profit margins of 26, 28 and 30%, and EBITDA 32, 34 and 38% was used, and cash from operations is calculated based on its relationship to EBITDA, which we saw it was at 98%, so that's why it is slightly lower than EBITDA numbers. CapEx, due to the rising costs, we set it at 8% across the board. And we can do the same as we did previously. We can calculate free cash flow by subtracting CapEx from cash flow from operations. And this gives us free cash flow from 7.2 billion to 10.2 billion and a terminal value calculated based on 2027 numbers of approximately 93 billion up to 172 billion. And here are analyst numbers for free cash flow, and as ASML is European company, I had to exchange euros for dollars. Okay, and as these are future numbers, we need to discount them back to today, and for this we'll use 10.5%, and here are the numbers we get from doing that, and we do the same for analysts numbers. And as I previously mentioned, here are our shares outstanding, our debt and cash, and as we can see, they have quite more cash than debt. So let's move on to our projections now. Our first is perpetual growth rate, where we sum up all discounted free cash flow and terminal value to get our present value, and then we add in cash and subtract out debt divided with the shares outstanding to get our stock price. And here we get a range of $264 all the way up to $460, and with analysts numbers with the same method we get $436. Moving on to EBITDA multiple valuation. Here we take two EBITDA multiples, one is for company average and one is for the industry average. We do this to get a clear picture how the company compares to the industry, and here we can see that ASML has quite a higher multiple than the industry, and the reason is simply because the ASML is the leader, so it deserves a premium. Now to get our valuation, we multiply our 2027 EBITDA with the EBITDA multiple, and for the company average we get a terminal value of 316 up to 556, and for the industry average we get a lower number of 217 up to 382. Then we again need to discount the terminal value to today and add in cash and subtract out debt to get our stock price range, and this for the company average ranges from around $680 up to $1,200, and for the industry average ranges from $473 up to $816, with analyst numbers coming in at $1,200 and $840 for the industry average. Now we can take both EBITDA multiple valuation and perpetual growth rate valuation and average them out to see what we get. And for the company average we get a range of $471 all the way up to $119, with average coming in at $640, with the industry average coming in at $368 all the way to $638, with average being at around $500. And analyst number is coming in at $284 for the company average and $638 for the industry average. Based on what you believe, these are all reasonable prices to pay for ASML, and ASML is currently trading at around $716. So if you believe in the highest numbers, then this company is a buy right now. Of course, here no margin of safety was applied, so be cautious as this is not financial advice, and do your own research before going out and buying ASML. Now before I give you my personal buying price, let's quickly recap why ASML is a good company from financial standpoint. First, for revenue growth we gave ASML all 3 points possible, with 12.4% growth over a long period of time, which is splendid. EBITDA and cash flow from operation growth matches, so we have less risk for financial fraud or some sort of mismanagement, so we gave them 3 points here as well. Next, looking at last debt and average debt should be less than 3 times EBITDA, Here we gave them 2 points because there is some debt, but even though it is very small, and they also have much more cash than debt, so they can repay it right away. So here is one negative: shares outstanding are not going down, and this is due to one big jump way back in 2012. And the next very good point is free cash flow from primary business, which is positive for all 6 years we looked at. So 3 points for them over here. Next, we can also give them some bonus points for dividends and dividend yield. It is very low, below 1%, so we gave them 0 points here. Dividend growth is impressive at 22%. Looking at cash amount only, so 3 points for them over here, and dividend payout, at least average, is at 35.5%, which is absolutely healthy, and they get 2 points for that. So based on all of this, ASML is very good and reliable company in my eyes. And based on all of this, for myself, I'm looking to buy ASML at around $500. I know this is quite far from what ASML is currently trading at, but my reason behind this lower stock price is cycles. I'll simply wait for a downturn cycle, and once that happens, I know I'll be able to pick up ASML at a lower price. Now, it does depend when this downturn will come, and another point for this lower price is also applied materials, as in my eyes, applied materials is much closer to a buy than ASML at current prices. If you're interested into looking at applied materials, watch this video next to see how they stack up against ASML. That's all from me this time, and I'll see you in the next video. Bye bye!